Welcome back to the Wealth Fact. I'm your host, Green Moon. Today, we're talking about credit cards. Credit cards are everywhere. Are they a financial tool or a financial trap? We'll explore the dual nature of credit cards, revealing how they can either build or destroy wealth depending on how they are used. The goal is not to vilify credit, but to understand it, as it gives you access, leverage, and options, but it also tempts you into shortcuts, comfort, and debt that compounds while you sleep. Let's fill your pocket. A brief history of credit cards. The birth of the modern credit card started in 1950. It started over dinner. In 1950, a businessman named Frank McNorman had dinner at a New York City restaurant and realized he had forgotten his wallet. Embarrassed, he vowed to create a system so people wouldn't have to carry around cash. That moment sparked the creation of the Dinner Club card, the first multi-purpose charge card. Initially accepted at 27 restaurants, it allowed members to pay with a card and settle their balance at the end of the month. It wasn't a credit card as we know it today, but it was like a prototype, and a new idea was born out of that, a cashless system. Then, in the 1960s, they introduced magnetic strips, banking partnerships, and more consumer-facing innovation. Major players entering the field were Bank of America, which launched Bank AmeriCard, later known as Visa. MasterCharge, now known as MasterCard, followed soon after. Other banks and retailers created private label cards to tap into this trend. As more merchants began to accept these cards, the idea of buy now, pay later moved from novelty to norm. And with that convenience came something else, debt. By the 1980s, credit cards were no longer exclusive to the well-traveled businessmen. Thanks to aggressive marketing, changing consumer behavior, and growing appetite for convenience, credit cards became an American staple. People were now using them not just for travel or emergencies, but for groceries, gas, electronics, and even clothes. It was the era of spending as a lifestyle. And with that, credit cards transformed from a financial tool into a cultural symbol. Some credit cards even became status symbols, like the American Express Platinum or the exclusive Centurion Black Card. Fast forwarding to today, over 1.1 million credit cards are currently in circulation in the US alone. We live in a world where you can tap your phone to buy coffee, auto-pay subscriptions without thinking, and even apply for new credit cards from your couch. Credit cards now serve multiple roles: financial lifelines for emergencies, reward engines for travel, cashback, and perks, credit score builders or destroyers, depending on the usage, debt traps, unfortunately for millions who don't understand the cost of interest. We've moved from physical swipes to digital wallets, from paper statements to real-time push notifications. But the one thing that hasn't changed? The psychology. As Ryan Holiday might say, technology changes, human nature doesn't. The temptation to overspend is the same. The emotional pull of buy now, deal later remains. What's evolved is the ease of indulgence and the illusion of control. They've become a status symbol, convenience tool. Let's get into how credit cards work. Credit cards aren't good or bad, they're just a tool. They can build wealth, streamline budgets, and generate rewards, or they can erode financial stability if misused. Understanding where they come from and how far they've come can help you decide how to use them going forward. At their core, credit cards are revolving credit lines. This means the issuer, usually a bank or financial institution, offers you a certain credit limit, and you are free to borrow against it, repay it, and borrow again. Think of it as a reusable loan. You can access it anytime as long as you're under your limit. Let's say your credit limit is $5,000. You spend $1,000, now you have $4,000 available. Repay back the $1,000, now your credit line is back up to $5,000. Simple, right? But here's where it gets tricky and expensive. Each month, you receive a statement showing how much you owe. You're given two options: The first one, paying in full. This allows you to avoid interest. But the second, pay the minimum due. You incur interest on the remaining balance. Most Americans don't realize that only paying the minimum is like signing a contract with compound interest that works against you. You're not just postponing your payment, you're feeding a debt snowball. This is because credit cards typically have a high interest rate. As of 2024, the average APR, annual percentage rate, on a credit card in the US is around 24%. Let that sink in. That's significantly higher than personal loans, which are typically 7 to 12%, auto loans from 4 to 7%, and even private student loans, which are 8 to 12%. If you carry a $5,000 balance and only make the minimum payment, at that rate, you pay thousands of dollars in interest over time, and it will take years to pay off if it ever does. This is how banks make their money, not just from few who pay their balance in full, but from those who don't. As Jim Rohn said, what is easy to do is also easy not to do. It's easy to pay off your balance monthly, but it's also easier to push it off until that small decision becomes a financial drain. Let's give another example. Let's say you owe $3,000 on a credit card with 24% APR. Your monthly payment each month is about 2% of the balance, or $60 in this case. It could take over 15 years to pay that off, and you would pay more than $4,000 in interest alone. That's not purchasing power, that's future income mortgaged for a short-term sacrifice. This is a system that rewards the disciplined and punishes the impulsive. Credit cards aren't inherently bad. They can build your credit, provide fraud protection, and even reward you like cashback or travel points. They are designed for banks to profit, not your financial health. Credit cards present you with a challenge. Can you master them, or will they master you? It all depends on how you handle that moment at checkout, that tiny decision to swipe and delay payment. And this is how credit cards play into the human psychology. Their instant gratification, the idea of buy now and pay later, the present bias, where we value today's pleasure more than tomorrow's pain, social comparison, as more and more people try to keep up with social media images, they tend to spend it all on credit. That's why credit cards feel much easier than cash. And it's not just speculation. It's been studied. Behavioral economists have long understood that people spend more when using credit cards than when using cash. One MIT study showed that people were willing to pay up to 100% more for the same item when using credit cards versus physical cash. Why? Because credit cards disconnect the purchase from the pain. When you hand over cash, there's a visible exchange. You feel it. When you swipe plastic or tap your phone, it's abstract, almost fictional. There doesn't seem to be a tangible loss, no moment of sacrifice, and that creates the illusion of abundance. If you're paying cash, there's a brief pause. You open your wallet, you count the bills, you feel the weight of what you're giving up. But with credit cards, it's a tap, swipe, and done. The dopamine hit stays, the costs get pushed into the future, and that's the illusion. Credit cards make it easy to feel rich while becoming poor. We now live in a world that rewards instant gratification. Buy now, pay later, 0% down, 12 months interest free. That sounds like freedom, but what it really is debt in disguise. It's easy to swipe today and ignore the statement tomorrow until the interest kicks in, until the balance grows, until the illusion collapses under the weight of reality. And here's the real cost of free. What they don't tell you on the flashy rewards websites or point hacker YouTube channels. That free vacation you're chasing with points might cost you 24% in APR if you're carrying a balance. That's $1,000 TV you couldn't afford in cash becomes $1,400 after a year of minimum payments. Credit cards don't give you free money. They give you expensive money as the hidden tax. It's not wealth, it's leverage. And leverage cuts both ways. And it's about training your mind, not just your wallet. As Ryan Holiday would put it, what blinds us is not the tool itself, but how we choose to use it. Credit cards aren't evil, they are neutral. But in the hands of undisciplined people, they amplify bad habits, such as impulses becomes overspending, convenience becomes complacency, just this once becomes a lifestyle. The solution isn't fear, it's awareness. Learn to pause before you swipe. Ask yourself, would I make the same decision if I had paid in cash? Is this what I need or what I want? Will this still feel like a good idea when the statement arrives? That pause, that single moment of clarity, is what separates the wealthy from the in debt. It's easy to fall into emotional spending when marketing taps into the fear of missing out, prestige, or rewards. The way out. There's no magic bullet, but there is a mindset shift in order to avoid credit card debt. Always aim to pay more than the minimum payment, as much as you can afford. Build a debt payoff plan targeting high interest credit cards first. Or, better yet, don't carry a balance at all. You can't outsmart banks, but you can choose to fight them or feed them. As banks and many credit card companies tend to prey on habits and vulnerabilities. And they don't hide it. They pre-approve people. They offer 0% intro rates, big limits for people with small incomes. And it's not illegal, but it is predatory. They don't encourage spending. They engineer it. This feeds into the present bias, where today feels real and tomorrow feels imaginary. The present bias is a well-documented psychological tendency. We prioritize immediate pleasure over long-term well-being. It's why we procrastinate on paying off debt. It's why we swipe a card even though we know we can't afford it. Unfortunately, when it comes to credit card spending, it's the inverse. We enjoy in imagination and suffer in reality when the bill comes. And one of the most powerful traps is social comparison. You see friends posting about vacation, scrolling past $2,000 outfits online. You watch YouTube videos with luxury hauls, new cars, high-rise apartments, and something whispers to you, you deserve that too. But here's what few would say out loud. Many people are financing their lifestyle with debt. The highlight reels you're comparing yourself to are often borrowed, leased, or paid in payments. They're trying to keep up with people who aren't even ahead. Chasing prestige with credit is like digging a hole to look taller. All that being said, there are powerful uses for credit card. When credit cards are used wisely, they can be a tool to build credit, provide emergency liquidity, fraud protection, and build up points, miles, and cashback. The key is not the card, it's the behavior. But there's a golden rule when it comes to credit cards. If you can't pay it off in full, you shouldn't be using it. Paying in full every month, avoiding interest, and using only what you can afford turns the trap into a powerful tool. When it comes to building your credit with credit cards, it's your financial reputation. It's like your report card as an adult. It determines whether you qualify for a mortgage, the interest rate on any loan, whether the landlord will let you lease the apartment, and even insurance premiums or employment in some industries. A good credit score isn't just about borrowing, it's about trust. Using credit cards responsibly, keeping low balances, paying on time, building a history of reliability. Let's talk about a few benefits of credit cards. Emergency liquidity. Life is unpredictable. Medical bills can arise from accidental injuries, your car breaks down, a flight gets canceled, and you're stuck in another city. When used wisely, a credit card can serve as a financial parachute, a bridge between calm and crisis. But here's the key. It's a backup plan. Having access to credit isn't the same as depending on it. but when used sparingly, it offers peace of mind in turbulent times. Fraud protection. One of the underrated advantages of credit cards is protection. If your debit card is hacked, there's actual cash gone, frozen, unavailable. With credit cards, dispute fraudulent charges. You're protected under federal laws like Fair Credit Billing Act. You're not liable for any unauthorized transactions. It's like having a financial bodyguard every time you swipe. And lastly, rewards. Let's be honest, who doesn't like free travel, cashback, or perks? Credit card rewards can be valuable if you're not paying interest to earn them, because what's the point of earning 1.5% cashback if you're paying 24% in interest? You're not winning. That's paying $1.50 to get 15 cents back. But if you're paying your balance in full every month, rewards are just the icing on top. They're what you earn for being smart, consistent, and disciplined. The behavior is key, not the card. Here's the core message. Having a credit card doesn't cause you to go into debt. Choices do. When you use credit as a substitution for income, you suffer. When you use a tool for discipline, you win. The difference between drowning in interest and flying on points is not the plastic. It's the person holding it. Responsible credit usage means you pay in full every month. You never spend more than you can afford. You track and review every charge. You treat your credit like a tool and not an extra income. This isn't about being perfect. It's about being intentional. Credit scores. Credit cards directly impact FICO scores, which affect your mortgage rates, auto loans, and even job opportunities in some industries. A 3-digit number that determines your access to money, opportunities, and even some employment. And one of the biggest items in shaping that number is your credit card. The most widely used credit score in America is the FICO score, which is a range from 300 to 850. It's based on 5 core categories, the first being payment history, which accounts for 35% of your score. This one's a big one. And the golden rule is always pay on time. One missed payment can drop your score by 50 to 100 points and stay on your report up to 7 years. Your credit card bill isn't just a payment, it's a promise you either keep or break every month. The second one being credit card utilization, which accounts for 30% of your score. This measures how much of your available credit you're using. If you have a $10,000 credit card limit and your balance is $3,000, you're using 30% of your balance. Experts say to keep it under 30%, ideally under 10%. High balances, even if paid in full, signal a risk to lenders. The third one, length of credit history, which accounts for 15% of your score. This is about time. The longer you have an account open, the better. It's why people tell you that first credit card you opened up in college, don't close it. It's an anchor to your credit age. It shows the lender that you're not new to credit cards. And the other influences are new credit, which accounts for 10% of your credit score. Opening too many credit cards in a short period of time lowers your score because it looks like desperation. There's also credit mix, which accounts for another 10%. Having both revolving credit and installment loans, such as auto loans, student loans, mortgages, show many financial institutions that you know how to manage different financial tools. So yes, credit cards influences 4 out of the 5 categories in your score. Think of credit cards like a mirror. It reflects your habits, your consistency, your values. If you use them with intention, your credit score becomes a symbol of your financial health. If you use them impulsively, your score becomes a warning sign. In modern finance, your credit behavior is your character measured mathematically. Are rewards worth it? Well, it depends on the user. If you're carrying a balance, rewards are like offering a lollipop to someone bleeding out. They distract from the real issue and cost more than what they give. If you're financially disciplined, rewards are a rebate, a perk, a calculated bonus, not a reason to overspend. But in the end, the smartest reward is freedom. Freedom from debt, freedom from marketing games, freedom to choose based on values, not points. And that's worth more than any cashback could ever be. Now let's talk about a few common myths about credit cards. What you don't know can cost you. In the age of infinite information, ignorance is a choice. And when it comes to credit cards, misinformation isn't just harmless, it's expensive. There's no shortage of financial advice floating around. Some passed down from old family members, others picked up from TikTok or friends who mean well, but don't know any better. As Ryan Holiday would say, just because it's common doesn't mean it's wise. Myth number 1, you have to carry a balance to build credit. This is one of the most dangerous and costly myths of them all. It sounds logical. If I have a balance, it shows I'm using my credit card. That builds my credit score, right? That's not true. Your credit score improves when you use your credit card and pay it off on time. Carrying a balance does nothing to help your credit score, and in fact, it could make it worse. Myth number 2, closing old credit cards helps your credit score. That's actually the complete opposite. You might think not using it, credit card scoring doesn't reward you for closing your cards. In fact, it punishes you. And here's why. Your credit utilization ratio goes up because you closed a credit card, because you reduced your total available credit. The average age of your credit card goes down, especially when closing a very old account. Both negatively impact your credit score. The better move would be to cut it up or use it occasionally on small purchases, but never close it. Myth number 3, one late payment won't hurt me. This is also a very dangerous myth because it's rooted in complacency. It's just one more bill. I'll pay it next week. It's no big deal. Actually, it's a very big deal. A single late payment can drop your credit score from 50 to 100 points, depending on your credit profile. Stays on your account for 7 years, and it can increase the interest rate on your other accounts. Myth number 4, maxing out your credit cards is fine as long as you pay it off at the end of the month. Another myth that sounds reasonable, but harms your credit score, even if you pay your full balance. Maxing out your credit cards before the statement date can spike your credit utilization, making it look like you've overextended yourself. Credit bureaus don't see your daily activity. They see your report balance at the time of the statement, like a snapshot. So as a final summary, here are some best practices for credit cards. Pay them in full every month. Never spend more than you can pay back. Set up auto payments to never miss a payment. Only use 10 to 30% of your total credit limit. Check statements frequently for errors or fraud. And avoid cash advances as they carry even higher interest rates. Credit cards aren't evil, they are indifferent. It all depends on who wields it and how. Used with awareness, strategy, and discipline, credit cards can enhance your financial life. The enemy is believing that tomorrow's you will clean up today's mess. You don't have to cancel every card. Don't aim to beat the system. Aim to become the kind of person who doesn't need to. Thank you for listening. Until next time.